The market is changing. Are you prepared? This is a question that every investor needs to ask themselves as we head into 2026. In this video, we're going to talk about three things. Firstly, we're going to try to understand what all happened in markets in 2025, how different asset classes performed, and how you stand as an investor within each of these asset categories. Next, we're going to break down why equity investors have had a very mixed bag in 2025. Lastly, we're going to talk about how you can prepare your portfolios for 2026. So stay tuned if you want insights on these three things. If you'd like to reach out to us or get some more insights on your portfolio, you can contact us on 9500027285. Now let's get started. First, let's look at what's going on at each asset class. When we look at fixed income, we started out the year with a neutral RBI policy, and then we quickly went into an accommodative stance with a series of rate cuts that have happened through the year. So the repo rate went from being at 6.5% to 5.25% today. This has translated into lower fixed deposit returns, lower returns from safe investments in the fixed income space. And this is weighing on senior citizens as well as conservative investors who've used traditional tools to save money. With interest rates falling lower and lower and returns also reducing, investors need to look at more tax efficient as well as wealth creating tools to get their asset allocation right. It's also been a difficult year if you've participated in duration plays where bond market volatility has played spoilsport despite the rate cuts. So keeping all of this in mind, fixed income investors may need to start looking at higher quality corporate bonds or corporate deposits. They may also need to look at other avenues, maybe hybrid funds, which could give them better risk-adjusted returns in this low interest rate environment. Now, moving on to the second asset class, which is precious metals. It's been a stellar year for precious metals. Both gold and silver have shown spectacularly, delivering upwards of 50% returns this year. Now, this is not a typical return for an asset class like gold or silver. There have been many contributing factors, including increased demand, central bank purchases, as well as uncertainty in the trade environment, divergence in terms of global growth, and a lot of question marks in terms of where we're heading in 2025 as well as 2026. What investors need to note is that this performance is unusual and is unlikely to repeat again in such a short span of time. Typically, when you have such a strong performance track record, you tend to see investors chase the asset classes that have performed. This is specifically where we need to be a lot more price conscious about what we're buying and how we're buying and positioning these assets within our portfolios. Now, coming to equities. Equities have had a very mixed year. So if you've been the large cap space, you've probably noticed that the index is at an all-time high or close to its all-time highs. If you've been in the mid-cap space, the story is pretty similar. But if you've been a small or a micro-cap investor, you are probably experiencing something completely different. So one is at the fund level, if you participated through the mutual funds, you're seeing some modest returns from your small cap portfolios. This has broadly been supported by flows. If you've been a bottom-up small cap or a micro-cap investor, the pain that your portfolios have experienced in 2025 is pretty steep. And this is where how you construct and manage risk matters a lot. When we look at portfolio construction that is bottom-up, while 2025 has been a rough year, it's likely that 2026 and the years beyond may be far more rewarding. Where portfolios are more passive or index-based, you're seeing a concentration of risk within a set of stocks, which could at any point reverse when liquidity also reverses. We are in a late stage cycle when it comes to the equity market. So you are going to see a rotation into more defensive and conservative ideas where liquidity will no longer be the driver of returns. And when that comes in, you need to have proper risk management practices in place to experience the best of equity investing. So this brings us to what will matter in 2026. Getting your asset allocation right is always going to be something that matters year on year. So positioning yourself to take better calculated risks on the equity side is exactly what is going to serve you well. So if you're a slightly more aggressive investor, you want to book out of profits, you want to book out of old themes and ideas and move into new ideas. A more bottom-up fundamentally strong approach in terms of having companies and businesses that have strong balance sheets, stable cash flows, and visibility in terms of growth is what is going to keep your portfolio supported. Chasing the hottest idea or the hottest stock pick is not going to work that well when liquidity is not flowing into the markets. On the fixed income side, investors should maintain caution, but should also lower their expectations in terms of returns or move towards more hybrid asset classes that could give them that risk reward that they're seeking. So opening up your avenues can help in 2026. We hope this playbook serves you well in the year to come. If you're somebody who's looking for professional guidance, then you are at the right place. Comment "I thought" below to get in touch with our team.